Well, morning all. Pleasure to meet you. Um, yeah, so I met Ollie probably about 3 months ago, maybe 3 or 4 months ago, and Ollie suggested that actually this could be a good forum for some of the discussions I had with Ollie that may be applicable to other entrepreneurs, and indeed just looking at tax efficiencies and investment efficiencies in terms of what you do inside your business and equally how that can relate to personal finances as well. So today's session will discuss and talk over a couple of areas. We can't cover it all. There's such a plethora and a huge array of topics that we could cover in between those two elements. But today we've picked out a couple of areas that Henry and I will talk through, and hopefully, if you don't already know about them, enlighten you on them. If you do know about them, it's good sometimes just to refresh. So a bit of background to Advies Private Clients. I set the business up, so I'm a founder of the firm back in 2006. Myself and still current business partner, James Wills, we decided back then, having worked for large insurance houses and investment houses, that we thought we could do this better. And ultimately, from a client delivery perspective, we felt we could be significantly more transparent and indeed add greater value to what the client actually gets. So we set up pretty much went out on a wing and a prayer. We managed to convince in the City of London a local office manager to lease us some space, a very small office. And thankfully, with a loyal client bank that we built up already, we set up, got authorized with the FCA, and literally cracked on with two desks, a couple of laptops, and a phone. We've grown that business over the last 19 years through referrals. And interesting to hear you're going to have a session at some point on referrals and growing business. That's exactly what we've done over the 19 years. We have very limited advertising. We use our clients as our best medium, for additional clients and for the business. So we've built to date purely on that basis. And now we're in a position whereby we acquire other advisory firms and individuals. So that helps grow the business further. But equally, still very much referral based from an individual and corporate client perspective. In terms of what we specialize in, very much personal and corporate finance and financial advice. So we have individuals who'll come through wishing to just review their circumstances and plan for the future. And equally, from a corporate perspective, we advise firms from small firms of 5 to 10 employees right through to multinationals in terms of financial plans, as it were, such as pension funds and indeed protections and insurances and things of that nature. So today I'm going to give a very short presentation. I don't want to bore everyone via a PowerPoint presentation, but it actually helps here just to see some visuals in terms of what we're going to discuss, and it brings it to a life a little bit. So if we're okay with that, I'll look to share my screen. Ollie, is that okay? And then we can crack on. Great stuff. Lovely. Right. Let me share this. So let me put you on slideshow if I can. Is that working? Bear with me 2 seconds. Here we are. Great. So today about building relationships between business and personal wealth. Now, talked about who we are. The fact we're directly authorized to the FCA, and very, very keen to emphasize that our business continually evolves, very much like yourselves. No doubt you've gone through many iterations as business owners, but one thing that has been a constant in our firm from James and I is that we continue to push the envelope. We want to continue to be seen as at the forefront of the industry. So we take on technology, we push advice from all sectors, as it were, and looking to lobby where we can for change. And it's a big part of the business overall. So in terms of who we work with, and honestly, we have no typical client. They've come from all walks of life. as I said, when we started up in 2006, it really was a case of doing the business, so getting clients through the door, giving them good advice and creating plans for them, and it's grown from there. And we've been referred through to, from accountants, lawyers, bankers, brokers, as I say, heads of industry, entrepreneurs. It's a significant part of our business because we can resonate with them in terms of what we've done and how we've built it. But ultimately and effectively, it's anyone looking to maximize their wealth and be tax efficient in doing that. Lots of people in our industry try and make things very complicated in terms of, whether it's legislative changes, whether it's tax, whether it's finance. Actually, we believe in simplification. We simplify these concepts for clients, and we just, ultimately show them how to be more efficient with their money overall. In terms of what we cover today, we're going to discuss what we term threats to your wealth. So that's areas such as taxation, inflation, legislation, death, and illness. Can sound pretty dull, but hopefully today, the bits that we've picked out will not necessarily entertain you, but hopefully be informative at the very least. And then we'll go on to discuss possible solutions to those threats. So considering corporate and personal investments, pensions, we'll come on to that in a bit of detail, cash management, both on a corporate side and personal side, look at insurances, and will and succession planning for the longer term piece. Okay, so let's start with the ugly one, which is taxation. We've all heard this before, two certainties in life. First one, taxes. This particular advertisement from Morgan Stanley a number of years ago really resonated with me because it gives a very good, in a very short phrase, a snapshot of actually how we should be managing our taxes. The fact that we have to pay taxes, whatever jurisdiction you're in, look, you have a requirement to pay taxes within that. But key point here is, and as they say, you don't need to pay more than is due, i.e. you don't have to leave a tip. HMRC give us lots of tools to utilize and take advantage of in terms of tax relief or tax relievers in respect of any legislation or tax regime you're within. So the question that we ask clients all the time, especially on the corporate side and entrepreneur side, are you being as tax efficient as possible? I'm sure majority may engage an accountant, and hopefully they're a proactive one, whereby they'll give you continual advice in terms of how you can be efficient within that. And a lot of our work is based around how we ultimately move assets. And when I say assets, it could be cash in your business from a corporate environment that could be subject to tax to a non-corporate, i.e. personal environment, without tax implications on that. And again, it's what HMRC allow us to do. It's what they give you. One of the benefits of being a small business, or indeed a limited company. Now, in terms of how we do that, the easiest way, and what we're going to focus briefly on today, is moving that money from a corporate entity to a personal environment. It's a company pension contribution. Now, how do you do that? So let me show you an example and illustrate how this actually operates and works. So as a business, whether, and depends how you set up, but for a limited company, for example, you can opt to make a pension contribution as an employer contribution from pre-tax income. So money sitting inside your corporate account, we can move that into a personal environment. And let me show you how. So let's take Ollie. Now, keen-eyed amongst you will see some resemblance to our esteemed founder. Slightly younger, unfortunately, Ollie. We've made this individual. Gives us a very good example over a 10-year period of how this individual plays out. So Ollie, a successful entrepreneur. He tends to draw 60K in dividends from his company every year, and he puts that into personal savings. It's not money he necessarily needs immediately, but that goes into a savings environment. He wants to retire at 57, and he wants to target 30K income in retirement as a comfortable lifestyle for him. Now, what I'll say about this example is going to be applicable irrelevant of size of investment, as it were. So if it were 10,000, 20,000, 30,000, the same principles apply. There are some upper limits on pension contributions, but we'll come on to that in a second. So how does Ollie reach his target? So how does he get to that £30,000 a year of income with 60k paying in on an annualized basis? Well, let's look at how dividends are taxed from a business and how pension contributions work inside that regime as well. So when you draw the dividends from the business, and in this instance, 60k gross, unfortunately, we have corporation tax to pay, and then we have higher rate dividends to pay, which effectively leaves us with just shy of half a net sum from your £60,000 gross withdrawal. However, if you direct that into a pension arrangement from the business, we don't pay corporation tax, we don't pay higher rate tax on dividends. So it's a net position. It's 60k out of the business, 60k into a pension fund. So effectively, we've bypassed corporation tax and higher rate tax, and this is all approved by HMRC. And this can go into your personal pension. So whether it's a SIP environment, a self-invested personal pension, or whether it's a stakeholder scheme or a plan that you've had, a legacy plan that you operate, or your current pension arrangement. So it's held within your name with your sort of title over the top of that. Now, pensions get a bad rep, and historically, people have looked upon pensions as pretty dull and boring. They've put money in, they kind of leave it in there and hope for the best when they get to retirement, that they've got enough money to retire on. They don't pay much attention on an ongoing basis to it, and effectively, investment funds that they're in will just languish and, over a 20, 30-year period, and as I say, hope for the best to get to the end. Well, we don't think they're boring because obviously it's a mainstay of our business. And ultimately, speak to any good financial planner, any good accountant, and they'll tell you they're the most tax efficient tool for retirement. Now, why are they so good? So let's look at, the components of that. Well, you get full tax relief on contributions. Currently, you can contribute up to £60,000 per year, and that's dependent upon earnings. And and again, if you've got employees inside your firms, it will dictate how much they can pay in. And you can also use what we call carry forward unused allowances. So, for example, if you have headroom, what we call pension headroom from previous years or unused allowance, you can carry that forward into the current year or set up a structure over a rolling period where we can utilize some carry forward from previous years. So you may have a significant sum you can pay into pensions, and that's over and above what we call the annual allowance every year for pension contributions. Right now, you can access it from the age of 55. That is increasing in 2028 to 57. And when you look to access, you can take up to 25% tax-free on the way out, and 75% is taxable. Key element of that, it's flexible in terms of withdrawals. You don't have to take the full 25. You can go into something called phased drawdown. You could take ad hoc lump sums. You can defer. You dictate, you decide on when you want money from these arrangements. The investment fund itself, it grows tax-free. So whether you have income funds inside your pension, whether there's capital gains inside there, you don't pay any tax on it. It grows tax-free. And key point of the pension, you decide on what you invest in. Pensions are no longer, in our opinion at least, dull. You could invest in whether it's hedge funds, whether it's alternatives, standard equities, bonds, fixed interest. There's a huge array, a huge universe of options you've got available to invest in via your pension arrangement. And, equally, depending on the SIP, you could invest in property. It could be commercial property. You may wish to purchase the commercial property that you are in, and you may be able to use part of your pension to be able to do that. So lots of options around that. So coming back to Ollie, if he was to max out this annual pension allowance over 10 years, so he's 60k a year going in, that difference in tax that he would have to pay if he took dividends, well, he's nearly he's over £300,000 better off. And that's before investment return or any compounding. Okay, it's gone into the pension. So there's his contributions going in, £600,000. Now, inflation, it's always a challenge. So that will impact any return or any interest that you get on your savings. And I thought it was a really useful graphic to show you over time, because, you know, as we go through life, we look at value of money and we consider that, you know, a pound is worth a pound. Well, it's not. If we go back to 1988, that £100 you had back then, well, today it's only worth 35.85. So it's really important that any money that goes into savings, be it cash, or goes into investments, be it equities or bonds or things of that nature, that we're getting return over and above inflation. We've got to target that as the first hurdle, as it were, and then any return above that being profit. So how do we combat this inflation piece? Well, the obvious element here is we need growth above inflation. So Ollie's put in his 600,000. He saved that 300 in tax. We need to achieve the growth. Two good ways to do that is to consider cash management. So if you're a risk averse individual and you just want money to sit in cash, well, how do we manage that cash? And secondly, smart investing, looking at how we actually invest in, you know, equities or different asset classes to grow our money. Now, hunting down the best rates for cash can be quite a laborious exercise. So we have clients, and I'm sure there's a number of you here today are very similar as well. We try and find best rates over a year period. We get to the end of that period, and then we think, oh, I've now got to find another rate. You've got to go through the rigmarole of filling in forms and setting up new account or changing account. Well, there's better options out there for you. And this is very much on the corporate side if you're holding cash inside your business, or it's on the personal side. These are cash management companies. They will do all the heavy lifting, all the dog, as we call it, in order to ensure that you are in the best interest producing accounts within their environment. So, for example, if we wanted to invest, for example, 200,000, 300,000 pounds, we want to ensure we're FSCS protected, so the 85,000 pound limit. Firms such as Insignis and Flagstone, they will manage that money for you and ensure on a yearly basis you're in the best interest earning environment you can. And you may not recognize some of these banks, but the key here is, as long as they hold FSCS protection, that is key. And they will ultimately hunt down the best rates for you. So rather than you doing all that work and spending your valuable time, rather than running a business, for example, or thinking of other elements, let cash management companies do that for you. And especially if you're holding money inside a corporate arrangement that you don't need access to for a period of time. So if you think, I'm not going to need that money for 2, 3, or 4 years period, look for cash management companies to manage it for you in the short term. Yes, they'll charge a fee, but that fee, when taken into account with a gross return, is still a very attractive proposition. Now, what else can help growth? So we recognize these, well, certainly recognize one of them. Some of you will recognize both of them, and you'll wonder what on earth is a snowball rolling down a hill for. Well, a key element that helps growth is compounding. We've all heard about compounding, but what does it actually really mean? Well, it's purported that, you know, Einstein had said that compounding is the 8th wonder of the world. I'm skeptical about that. I think that was probably an investment banker making it up to try and convince a client to invest some money. But Warren Buffett, one of the most successful investors, certainly over the last century, he sees compounding just like a snowball running down a hill. It continues to gather snow. And ultimately what that means is, if we look at example of for Ollie, well, if he put that £60,000, let's say, into a cash environment, and on his cumulative deposit basis, he accrues interest on that, at 4% net. Well, just by doing that over a 10-year period, that compounding effect has generated £152,000 of effective growth for him. Now, I'm not taking tax into account here in that nature, just want to show a simplified example. So his £600,000 that he's put in over that time has resulted in £752,000. Taking you back to his requirement for £30,000 income in retirement of 57, sustainable for the rest of his life. Well, guess what? 4% assumed withdrawal from that sum is circa 30k gross per year, and that is sustainable or deemed sustainable for the rest of his life. So just by benefiting from compounding, cash managing well, looking for the best rate on an ongoing basis, Ollie achieves his goal. Now, what about if we think, well, we're happy to take a bit of risk here? So cash, we understand, can be eroded by inflation over time. We're just lucky to a degree as savers that interest rates are where they are right now. Historically, we know they've been lower than that. But let's say we want to take a bit of risk on. So we could look at equities. We could consider property as our pension environment. So if we want to buy commercial property or indeed residential property, how does that compare to cash? Well, fortune definitely favors the brave in terms of history when we look back. So over time, what we can see on this blue line is equities. Now, they've suffered badly during sort of credit crisis back in 08 to 12, suffered during pandemic, and recently in 2022 with equity and bond reduction and inflation rising. But when we look at that return over that 20-year period, well, we can see it's a 283 gross percent return on that. Versus cash comes in at about 34 and nearly 35%. Interestingly, property, which lots of clients come to us and say, look, my pension is my properties. Well, property hasn't done as well. It's done better than cash, of course, but against equities, it's a one-horse race, I'm afraid, on that. But property can be very much a good part of a portfolio. So if we consider that actually if you place our money in equities or even indeed property, what would that look like for Ollie? Well, add compounding, add that sprinkle of compounding on top, and we'll see based on a variable growth period, so 10 years with ups and downs, and then we just chose one of our portfolios because that's what we do well. Well, Ollie gets significantly better return. He's taken more risk to get there, yes, and some years won't be as good as others, but he's effectively grown his environment, he's grown his money by approximately 75% during that period. Now, you don't have to be, either cash or either equity or one or other. You can sit in the middle. You can have some cash, some property, some equity. The key element I'm trying to explain here and to emphasize is do something with your money. It's don't let it languish in cash environments, in per interest-bearing deposit accounts, would be them corporate or be them individual. There's plenty of options out there for you to benefit from. So do something with any cash that you've got. And if you're considering speaking with your accountant or you're doing your tax returns at the end of the year, your company returns, can I divert some of this money into a pension environment and then benefit from that being in my personal environment without paying tax? Okay. Now, coming on to one of the other threats, legislation. So again, something that crops up regularly is, but legislation may change. Well, guess what? It's always changing. So whilst we can only advise on the here and now and what's in, the current legislature, well, do you know what? We know there's going to be significant changes over our lifetime. The key is to ensure we're flexible with this. And I wanted to give you one example that may resonate with you all, if indeed you've got employees inside your businesses. And this is most recently announced by Rachel Reeves, is that employer national insurance is going up from 13.8% to 15%. Lots of lobbying going on from small businesses, SMEs, and indeed the larger institutions. You'll see in the press, the big supermarkets coming out saying, look, this is going to cost us an awful lot of money and jobs may suffer. But one of the ways to combat this is considering salary sacrifice. Now, that is something you may have come across in, you may operate today with some of your employees, or indeed you may have come across it in a previous career position. And this is whereby effectively we're going to sacrifice some of our employees' pay. And I say we are, the employee, in this instance, Rachel, she's going to sacrifice some of her pay in lieu of a pension contribution. And how does that work? So in Ollie's firm, Rachel earns £50,000 a year. She receives a pension contribution from the business of £5,000, and she contributes a further £5,000 from her post-tax salary. So at the moment, she gets her gross salary, she pays tax on that money, and then makes a pension contribution. Well, we think she can do that better. Ollie gives Rachel an option to sacrifice some of her gross pay in lieu of a pension contribution. And I'll show you in a second, we can keep her net pay the same. By doing this, Ollie's about to save some employers' NI. So how does it work? If I can just guide your attention to this column here, before salary exchange. Here's Rachel at 50K. Her annual pension contribution is 2.5. She pays tax, she pays NI, and her net pay is 37,519. In doing it via salary exchange, she is going to sacrifice some of her gross pay. Yep, she's going to give it up and for that to go into her pension. But we are going to keep her net pay the same. And effectively how we do that is we work the numbers, we call it work it backwards. She pays slightly less NI because she's paying on a lesser gross salary, and she pays less income tax. Key here, you'll note there's no pension contribution from Rachel. And that's because she's asked her employer to make it on her behalf. Okay. So for Ollie, what does it look like from a business? Knowing that NI contribution has gone up, Rachel Reeves has said it's gone to 15%. Well, currently, before anything changes and Rachel makes her pension contribution from post-tax earnings, well, gross salary is 50K. Ollie's paying NI contribution of 5,644, pension contribution of 2.5. So the total cost to Ollie to employ Rachel is 58,144. However, after salary exchange, so if Rachel decides to give up or sacrifice money into pension, you can see that actually the NI contribution has come down for Ollie on Rachel's behalf. Pension contribution has gone up because he's making that. But ultimately, for Ollie, it's a reduction in overall cost. So at nearly £400 reduction, purely based on Rachel giving up salary in lieu of a pension before she pays tax and doing it via salary exchange. So it's these type of mechanisms that if you are not well versed and you're employing people and you are ultimately under auto enrollment rules, you have to pay into a pension for your employees. Well, if you're not availing of these types of structures, which are now very mainstream and HMRC approved, I would encourage you and urge you to do so. Now, you are all building up, hopefully, very successful businesses. Key to that is to preserving it. So within your arrangement, within a company structure, you may already have certain protections in place. So certainly on the legal side or the PI side, to protect yourselves, you should also consider, and this is just to disturb you in the sense of considering arrangement, there's certain insurances that are allowable expenses, and certainly your accountant can make representation for you on this to your local inspector of taxes, but certain protections that you can utilize via your business that are allowable. So considering things like key person protection. So if you've got a key individual in the business, and if something were to happen to them, you don't want to see profits fall. You want to be able to replace them quickly or on an interim basis or indeed full time. Well, key person protection can do that. And it pays out a sum to allow you to do that. Shareholder protection, again, protecting the asset you've built up. If anything were to happen to you, you may want that business to continue on, putting shareholder protection in place, which also helps then to compensate family members for the value of the business or your contribution to the business. Shareholder protection can be very useful. Relevant life cover. Again, this is life cover. So you may all be operating individual life cover plans at the moment that you pay out of your own pocket. Well, guess what? Under a relevant life cover arrangement, you can use your business to pay for that. So effectively, you are getting a reduction in premium, a discount on the premium because effectively it's tax deductible to operate your life cover via your business, not via your personal pocket. And then there's things like private medical insurance, and that is all about saying, well, look, whilst not tax deductible, again, something I urge clients to do because it gets you back to work quicker, or ultimately gets you in front of a consultant as quick as you can. But consider those in terms of safeguarding you and your business and its future, and some of these arrangements can be tax deductible. Now, overall, and as we've touched on a couple of elements in terms of efficiencies, we like to educate our clients on future-proofing their finances. And what is that about? Well, it's about, having defenses against all those threats we've just identified, and it's building a financial plan. I am sure you've all built business plans for, over the next 5 years, 10 years, how you want the shape of the business to look in time. You've run your numbers, you've looked at the P&Ls. Well, the same should apply to your personal life. Whilst you're building up this business and your attention is rightly on that, whether you're a fledgling business or ultimately been in business for many a year, it's really important that you look ahead. For us, we see lots of entrepreneurs who get to a point of selling a business. They haven't thought about what's next. They get a lump sum of money in and they're struggling to say, well, what's this going to do for me? What's next in terms of, ultimately what assets should I be invested in? I've got junctures ahead, whether it's school fees, whether it's deposits for kids, whether it's round the world trips. We encourage clients to put together what we call a timeline report. And that timeline builds in cash flow, and it looks at major events that may be occurring, further down the road, or aspirations that you've got. What timeline does, and building such a projection, it allows you to look into the future to give you a guide using historical data, but gives you a guide as to how that plays out. You can adjust it as often as you wish on an ongoing basis, taking into account better times, worse times, but it allows you to take the stress off you, considering what does retirement potentially, or what does the next phase look like after potentially you've sold your business, or whilst you're building that business up. So I'd encourage you all, if you have engaged with a financial planner, or indeed, speaking to your accountant, consider putting a financial plan or a cash flow or timeline plan in place. It's something that when we started doing this over a decade ago for clients, it was a real eureka moment in that clients use this tool now on a yearly basis to update us, consider their plans ahead, make adjustments, and knowing in some instances they can retire earlier because they thought they had to build up a huge fund and considering expenses ahead. Well, we proved and demonstrated them that they don't need to do that. In some other instances, they needed to do more, but it highlights for you all the effort you're putting in as a business, or into the business, I should say. Well, it's got to mean something longer term. Timeline and cash flow planning gives you that sort of foresight, as it were, as to how that can look. So, talked a lot. I appreciate that, and I very much appreciate for your time. But just to cover off, the key elements of today, we've identified those threats and challenges to you as individuals, business, and showed you how to utilize your business in order to grow personal wealth. So important that you either engage your accountant to talk through that, those options, or indeed a financial planner to do that as well. And one that's au fait with entrepreneurs and your business in terms of how the structure works. We've looked at smart investing and compounding. Honestly, it's the most simplistic investment tool you can engage with, whether it be cash, whether it be equities, but something always to consider. The longer you leave your money in an environment, the more it will compound, the better off you're going to be. But overall, and for my 20 plus years advice, the one thing I'd ask you and encourage you to do is build a plan for you as an individual and a business owner. You've done it for your corporate entity, as it were, your business entity. Do it for you as an individual as well. Really important. You are planning for the future, and finance will drive a lot of that. There we are. Thank you all. Really appreciate your time. And if you want to ask queries, questions, I'm more than happy to answer.
Conor, that's been fantastic. Thank you very much. Dan?
Not really a question. I just wanted to say thank you so much. Really insightful. I've got a few different pension pots from existing employers. I've got a SIP. I've got my personal investments in stocks and shares, plus art, plus property and things like that. But I never would have considered that I could have used my business to that advantage as well. So yeah, incredibly insightful. I was screenshotting all of those slides as we were going along. So
thank you, Dan. Appreciate that.
I look forward to it. It's been recorded, so I'll definitely watch the recording back and yeah, it's just incredibly useful. I didn't realize half of that stuff. So yeah, thank
Great.
you so much for
Well,
sharing. And
I know we've only had a short period of time today. There's loads of other things that you can all consider. And do you know, all it takes is just an engagement with a planner. Go and seek, and you may already have planners, go and seek advice from them. They will tell you about these things. And just like as we all started businesses, the things you learn, and it's a steep learning curve, right? So the more you can engage with people like you do on this forum, and you just pick up these ideas and you pick up the elements, it can be fantastic.
Well, my accountant, just one small thing. I used to pay national insurance contributions manually. So I used to pay things like 100 quid or 150 quid a month or something like that. And my accountant was like, why are you doing that? Put yourself on your own business PAYE, and then it pays the national insurance contribution. So I did that, and I got a full year of tax contributions without actually paying the £150 a month. So
I know.
little things like that. Again, this is why you don't get bored knowing this. And
no,
and I'm definitely not an accountant by any means. So all of this sort of stuff by experts such as yourself is priceless. So yeah, thank you so much.
Great. Absolute pleasure, Dan. Great.
Any additional questions for Conor and Henry this morning, guys? I think we've exhausted. I think this is a really important area, and so many founders ignore it. I believe, Conor, because they think their business is the pension in many cases.
Yeah.
Now, when you consider what the government are doing to capital gains tax and other things, we've really got to start thinking outside that. So I think this is a very well-timed, important talk. And you two are welcome back anytime.
Thank you. I really appreciate that.
What you're going to get over the next few days is a lot of love, big ups and shout outs on LinkedIn. All right. So get ready for that.
Lovely. Thank you, Ollie.
Connor, can you send me the slide so we can pull it in?
Of course I can.
Share it with our overall community. Please.
Of course I can, Ollie. Yeah, no problem at all. I'll get them off to you today. Great. Thank you, everyone.
Thanks,
Pleasure to meet you all.
Thank you.
Bye.
Bye.
Thanks. Bye-bye.